Welcome to another episode of No Comment. My name is Łukasz Zeligorski, and with me today is
Marcin Welkowski.
I'm very glad, Marcin, that you're here with us today, and we'll be talking about important matters, as always, on No Comment. And those waiting for the most important part, the fun facts, won't be disappointed either, because as usual, there'll be substance. The creme de la creme. It'll be there, of course, but today we'll be talking about BlackRock, we'll be talking about
MicroStrategy.
About MicroStrategy, of course, and also about Gen Z, and we'll talk for a little bit about how to store your Bitcoins. But first, let's start with MicroStrategy, or actually strategy, as it's sometimes called. They've been in the news lately. Michael Saylor, considered by some until now to be almost a god, has now suddenly moved to the exact opposite side of the fence. What's going on there? Tell us, Marcin, what's the news?
Yes. Maybe we'll start with me calling Michael Saylor, Michael the Sailor in Polish. I think it might catch on nicely. It's from our colleague at work. Shout out to Krzysiu. He's the one who came up with it, Michael the Sailor. So Michael the Sailor created MicroStrategy, today known as Strategy. It was founded, the IPO was in 2000, and Michal had 79% ownership in this company. He's the only one with Class B shares, meaning he has 10 votes per share, while everyone else has 1 vote per share.
Let's recall that when the company was founded, it was during the great boom of dot-coms. It was a software company developing innovative software from a very tiny firm, literally barely valued at all. Then came a huge boom and eventually a truly huge success.
Exactly. Everyone was pretty much congratulating him because he did the IPO at the perfect moment, meaning he managed to sell those shares just before the dot-com bubble burst. I also analyzed the business side of it, not the Bitcoin side, because we'll get to the Bitcoin part in a moment. And this is interesting because how many people do you think Strategy employs, Łukasz?
Well, in that software business, I'd say 200 people.
1,500.
So a large company.
A large company. I was surprised too. I thought it was a smaller company. And now their revenue is about annually $500 million. Operating profit is 330. So a pretty good profit. Looking at the revenue, they have quite high profitability. These are mainly SaaS solutions and subscription-based. That's why they currently have few
costs and
lots of revenue. So to sum up, because this is still small money compared to what we're talking about with Strategy as a whole, but they have flow, meaning they have that steady income. It's roughly 330 million in profit coming in. MicroStrategy, or MSTR, that's the ticker, Strategy, has never paid out a dividend. It's often mislabeled because other tickers, meaning other subshares, paid out dividends. Strategy itself never paid dividends, and their first Bitcoin purchase was from their own cash. So
2016?
I can check in a second. I think it was a bit later than that.
I just remember that when MicroStrategy back then was achieving great success, their shares were trading really high. I don't recall the exact price now, but it was several $100s, and in just a few months or maybe even weeks, it dropped by 90%. And at one point, it even bottomed out at nearly 99%. And here, Michael Saylor, I'll speak perhaps more formally. Michael Saylor still says and emphasizes the fact that if you look at it, he's one of the few CEOs who, after such a sharp decline, didn't give up, didn't pack their bags and didn't say goodbye. I've already made my money, because he had. And yet he kept trying to rebuild the business. He worked on it for, well, over a decade. And once he discovered Bitcoin, from that point on, we can say that MicroStrategy started to be on everyone's lips again.
That's right. I checked, the first Bitcoin purchase was in August 2020.
Oh.
So for 2 decades, it effectively functioned as a SaaS company. And that was a purchase of 21,000 Bitcoins for $250 million. And that was the only purchase made with the company's cash.
Okay.
That was the first purchase. All subsequent purchases were funded by products that were created additionally. And maybe we'll start with those products. The first products that were created were strictly bonds. Bonds with a very low yield from 3% down to even less than 1%. Only one of those was actually backed by Bitcoin. while all the rest were backed by shares. So you opted for such a notably low bond yield solely for that reason. Because after 3 years there was a redemption, or you could forego it and get company shares, a new share issue, which meant you'd get those shares at a lower price.
So with an added bonus, that price actually had a significant difference. It wasn't just a few percent. Those were quite good terms.
So almost no one was focused on that interest rate. That rate was just for those 3 years where you don't receive it. I even found some bonds that were issued without any interest rate guarantee.
Okay, 0%, right?
Zero. No, it was more like if we earn it, declarative. But it's not about bonds. That matters, because here, although the capital raised, well, we have 1 billion, 800 million, 800 million, 2 billion, 600 million, 3 billion. So in total, we can calculate that it was over $7 billion raised through bonds.
That's quite a lot. And did that money go towards buying Bitcoin?
Everything went towards buying Bitcoin.
Okay.
And the annual interest cost of these bonds is 0%. So there wasn't even any, because they were declarative, that they would just pay out as much as they earned, as much as they decided to pay out. And for others, it's 6 million a year, 5 million a year, 5 million a year, and 18 million a year.
That's ridiculously low.
Ridiculously low. And the assumption here was that these bonds would be repaid through the company's operating profit.
Okay.
Profit. The company earns 300 million. Here we have about 30 million in annual costs, so there won't be any need to sell Bitcoins. And now we move on to the more important ones, which is the stock issuance. Something that we don't really have is the at-the-market program, meaning creating new shares for a company that already exists, which have a different ticker.
So in short, a company can issue shares, hold them in its treasury, and when it wants to, it releases them onto the market.
Yes. Well, we can put it that way. And here we also have several of these shares. Oh, and also regarding the main shareholding, because that might also be interesting. I looked into who the main shareholders are. Michael Saylor, or Michael the Saylor, since 2000, November 2024. Only then did he lose 50% of the votes, not shares. Because, as I mentioned, his shares were worth 10 votes each uniquely. He was the only person who held those shares. And then he stepped down. He's no longer the president, but he's the executive chairman, meaning the chairman of the supervisory board, and not the CEO. Often mistakenly called that the CEO is someone else. I also checked who else is in the shareholding. There's Vanguard, of course, 7%. There's Morgan Stanley, 2%. CalEster, California State Teachers Retirement System, which is a pension fund, holds about 2% of the shares. Shorted shares, on the other hand, make up around 11 to 12%. So, well, that's it.
Okay, that's not so terribly bad.
It's not really a lot, but honestly, it's not exactly a little either.
Yes.
I found that some companies have 1, 2, or 3%. 10% is considered normal. Over 20 is already too much. So let's say they have funds that, because these are fund-based shorts, these are funds that short them constantly with low leverage. Times 2, times 3, there's no high leverage there. But let's move on to those more interesting shares. There are a few tickers here. Maybe I won't zoom in on them if I find them quickly, but maybe I'll explain what it's all about. So he created these shares under shares and sold each of them for $100. With them, from their sale, he bought Bitcoin. These shares have interest rates, again, slightly different, like bonds, from 6%. Some have non-guaranteed ones. So if the company generates...
They have no obligation to pay out dividends.
It's declared, but the company can actually skip paying it. And when that happens, the skipped dividend does not accumulate or carry over to future periods. So basically, you can...
So they have free money, you could say that.
That's right, but in 1 year, for example, they paid 30% on those shares, right? Because those were the aggressive ones. They were called aggressive, which is why they wanted to remove that risk. But there are their most famous shares, which are shares... I'll check in a moment exactly what ticker it is. It's the ticker STRC. These are the most controversial and best known, firstly because they're very large, and secondly, the interest on them was supposed to grow. So it was supposed to be from 10 to eventually 12%. And it was scheduled over the years when that would happen. And now we're about to hit 12%.
It's also a type of financial instrument, this STRC, if I remember correctly, that they issued, they guaranteed, or guaranteed in quotes, perhaps, that they would have a stable price, $100, but they would give well-growing, as you said, dividends, which are additionally paid not once a year, but from what I remember, once a month.
Yes. I mean, it grows exactly as it was in the declaration that it will grow. It was from 10, now it's already 12%, and that we'll want to pay them out as often as possible, but annually we must pay 12%.
Okay, sure.
They're trying to pay out every other month now. They'd like to every month.
Oh, I see.
And they didn't guarantee 100% per share. That's also
$100.
$100, right?
They didn't guarantee, but
that's what they sold them for.
Yes, that's what they sold them for.
Yes, so it would be easy to calculate that you'd get $12 per share then.
Yeah.
And here is exactly where the entire problem in the overall strategy really arises. And this is where things start to get complicated because you see today's most recent sale has become a real issue, mainly because those shares, which were once much higher, dropped all the way down to as low as $70 per share. So MicroStrategy lost the ability to raise capital because how do you sell a share for $100 to anyone?
If I can buy them on the market for 70.
That's right. And they will have the same interest rate. Well, you'd have to issue new ones with a higher interest rate. Yes. And that's where all this confusion came from. Turnover. This operating profit is not enough to cover these bonds because it's about 800 million annually at the moment. So MicroStrategy decided to sell Bitcoins to have for the dividend. And what's more, to even, of course, it's a declaration. They haven't committed themselves in any legal way to simply buy back those shares, not the main ones, but rather some of the smaller ones. Well,
MSTR?
MSTR. Well, because they're with today's ticker, they want to raise their price to be able to later again raise capital for Bitcoin.
You could say it's a pretty good operation. I sold something for 100 zlotys. I'm buying it back for 70. I think it's not a bad business.
Yes, but let's not forget that they have Bitcoin at a higher price.
Exactly. And that's also the trick. We talked about it in the quarter with Kanga. Because if you look at the balance sheet, in June, some amount was spent to buy Bitcoins. Then almost all of those Bitcoins were sold now. Remained, the difference is probably 61 Bitcoins. And it looks like for those 61 Bitcoins, the company paid $250,000 each because that was the difference in the exchange rate. So they bought those Bitcoins quite expensively.
But there's also often such a prediction that Michael Saylor is running a financial pyramid, that it's about to collapse. So here I have to reassure you a bit because I analyzed for really a few good hours. I spent on these numbers. They, by selling these Bitcoins, secured themselves a year
for the payment of those interests.
And over 200 million for the buyback. They want to allocate for the buyback, not of Bitcoin, but of those shares, which are with a lower, like this difference between today's Bitcoin price and their purchase price, because their purchase price is 75,000 there on average, and the Bitcoin price today is 62,000 as of today.
Well, so a 20% difference.
So here's a bigger gap, a bigger difference.
So it's more profitable for them not to buy Bitcoin, but to buy back those shares because they'll have better financial leverage. At least in the books, it will add up.
In the books, yes. That's exactly the point. Because we can't say the same about growth scale potential, right? But yeah, absolutely, because they'll still only be paying out 12%. It won't grow to $300, like we think Bitcoin might triple, for example, or quadruple. Well, it probably won't grow that much, but it's meant to give them the chance to raise more capital for Bitcoin. So if we think about it, I did this analysis, a crash test of what would have to happen, how much Bitcoin would have to drop for MicroStrategy or strategy, well, to be in the red, because like I said, most of those bonds, most of those shares aren't backed by Bitcoin. There's about 5%, just those first ones, which already de facto will either have a zero ticker or a very small ticker where there's no risk for them. Bitcoin would have to drop to $4,000 and stay there for 4 years.
And that could actually threaten.
Then they could run out of liquidity after 4 years. because they'd start selling Bitcoin at such a loss that, well, it would start shrinking disproportionately, right? So
it's a ways off.
Still a ways off.
So they still have a cushion. I watched an interview with Michael Saylor yesterday. He went a bit quiet for a while because actually, until now, he was always saying, don't sell your Bitcoins.
He broke the paradigm, and I think that's the most painful thing for the market.
Okay, because he said, don't sell your Bitcoins. Then everyone said, okay, so strategy won't be selling Bitcoins. Then it turned out they actually will be selling. Yeah? And his point was that we shouldn't sell Bitcoins, but he can, at least that's how he explained it. I know there's also a certain kind of financial maneuver going on. I mean, first there was talk that companies like Strategy are hard to value because if they have something in their treasury that's hard to
value, okay,
and they've never sold anything, then it's hard to say they have any value. So that was one such.
Yes, but that was that first sale, those famous 32 Bitcoins. And that was strictly for the rating agencies. Because one of the big agencies started assuming that, well, we can't value those Bitcoins because we don't know if you can sell them, right?
It's a case, I think, that could be called Zonda Crypto because they had Bitcoins they couldn't sell. It happens. So Michael Saylor said, okay, here you go, I'm selling. He sold 32 Bitcoins. He was heavily criticized, but it kind of went unnoticed, right?
Because on the same day or a week later, he actually bought much more.
Much more, yes. And now there has been a massive sale specifically for strategy of Bitcoins. However, it really was not anything particularly significant or especially large for their overall market because it wasn't some...
Not even big for their treasury.
Exactly, because it's still just some fractions of a percent.
Yes, less than a percent. It's 0.3, 0.2%.
So it's not really some huge amount, but still that breaking of the paradigm you mentioned did happen. And well, they did end up selling at a loss de facto.
Yes.
And that's the financial element people are starting to talk about in the market, that this sale was aimed at generating a certain loss that gives them tax benefits. I don't know how it was. I think it's a bit like looking for some kind of justification. I don't know. Martin, did you do some investigation into this?
No, but I looked at it more from a market-wide perspective, moving away from strategy a bit.
Yeah.
I don't know if you've noticed this too, because I often, well, I don't want to act like the alpha and omega, but sensing the proximity of the bottom and sensing the proximity of the top. When very bad news comes out and the price only drops slightly,
well, then we're likely dealing with a bottom.
And now look at what happened with strategy. They sold a lot of Bitcoins. Those 32 were symbolic, right? They've sold a lot of Bitcoins now. What happened to the price of Bitcoin? It barely even reacted.
Yes, it was a minimal change and it bounced right back anyway.
And that's why I bought right away. I decided to, because if...
This is not investment advice.
Of course. If bad news in a bear market doesn't push you down, then what's supposed to push you further, right? And it's the same in a bull market. If very good news comes out and it does nothing, that should be a red flag for you, right?
Yeah.
And that's why I went for another purchase here. But that's just me individually, of course.
Listen, here's a very interesting hint from Martin. If there's an asset and some bad news comes out, but the price doesn't actually drop and the price is already lower than we would normally expect anyway, well, then it probably won't drop any further. And when it's in that upper phase and good news comes, but the price doesn't rise, then maybe that's a signal to sell. A very interesting strategy. I'm just wondering to what extent this sale also affected the market in general, because I don't know if you heard that JP Morgan just changed their recommendation for strategy shares.
Oh, I didn't.
They just changed the recommendation.
To buy?
To buy.
But, well, first of all, when it comes to strategy, I really feel like they should, in addition to their investment conglomerate, which is quite interesting and honestly very American, also think about how they approach things overall. It would be very difficult to do it in Poland, right? Let's establish one thing. This is a very American system. I sometimes get the feeling that they're like a counter indicator. Because look, they sold 32 Bitcoins and crashed the price to today's level.
Yeah.
That's when you should have sold at that high price, right?
Well, yeah, they would. That's exactly. You're right about that. Let's recall there was a situation where rumors were flying that strategy might be selling. The price was quite well higher than it is today.
Close to 70, right?
And it just dropped like a stone. And now they've sold over 100 times more. And when it comes to the price, you could say, well,
it didn't react. Well, it was a few hour reaction, so it didn't really react. And now I've even seen it on the market many times that when MicroStrategy said they bought, there was usually a better price within 48 hours.
okay.
I don't know if they make such an impact with that purchase, or
A better price, meaning lower?
Lower in the sense of a better price to buy. And that's also a problem of success for strategy, because they raise the most funds to buy Bitcoin when Bitcoin is expensive.
Well, but that's a typical situation,
But it's a pathology, right? Because at the moment when they should be buying like crazy, they say, we have no way to raise capital.
Yeah. I recently had a conversation like that with a friend, and he says, well, I asked him how his buying is going because I knew he'd wanted to invest his money for over a year now. So he says, well, just take it easy. I'm just waiting for it to drop even more. And I say, but when Bitcoin was over $120,000, you made your first purchase because you expected growth despite such a high price, right? And now when it's dropped to 60, you're not buying. I say, why? Just average it out lower.
Your price.
What's going on? It'll just end up with you buying at 120,000 again. When it comes back, yeah, so that's a problem. We have a certain, there's a good book, Thinking Fast and Slow.
Yes, very good. We recommend it.
There, I think that this could actually be a very good example of one of those traps, specifically the kind where we really do not tend to think very rationally about our finances.
The opposite of store sales, because when we see a big red sale sign, we run to that store.
Yeah, that's not rational either.
But it's more rational.
Well, yeah, I guess.
Well, the problem there is that we often buy what we don't need, but I've long ago set up my strategy so that I've found assets I want to accumulate and I just want to accumulate them. So the cheaper it is, the happier I am, the more I can buy.
Yes, well, here as usual, the DCA strategy comes into play again. So for those just starting out, I'll remind you, DCA stands for dollar cost averaging. It's an abbreviation for that difficult English name, which in Polish means price averaging. In my opinion, it sounds much better. We buy constantly, we buy regardless of the price, or for example, when the price falls below a certain,
buy more, right?
Then we buy more, and we really do not look at the price. If we have an asset that we genuinely believe will grow in value over time, once we set a threshold below which it is worth buying, it is definitely worth starting such a purchase plan. This approach helps us stay disciplined and focused on our long-term goals rather than reacting to short-term price changes. And an even better solution is the possibility of simply buying constantly, regardless of what the current price might be. And all the statistics show that people who approach saving and investing in this steady, consistent way do much, much better than those who try to find the lows and the highs. Of course.
In the long term?
Yes. There are situations where someone manages to catch a low or catch a high. But if we look at history, it turns out that much more often it's just not possible to do that. And the benefit of finding that low and that high disappears in the losses that are realized or created during unsuccessful purchases. It's kind of like playing roulette, or really gambling in general. We tend to remember our successes much more often than our failures.
Of course.
And we don't remember how much we lost. So that's.
But Lukas, tell me, because maybe I'll cleverly move on to the next topic. Do you think that Generation Z is able to use DCA?
Well, that is certainly a very good question, because I have actually been looking a little bit at what lies ahead for us in the future.
I listened to
a lecture about Generation Z unrelated to Bitcoin. It was a sociological lecture, and some interesting information came up there that prompted me to do a bit of research. It just piqued my interest. It turns out that Generation Z, surprisingly, I am being ironic, of course, is completely different from the generation before them, meaning millennials, Gen X, and baby boomers, if they are still around.
Lukas, which one do you belong to?
Well, I am unfortunately still in that baby boomer one, I think. So here I am, still one of those. Of course, there are many comparisons of these generations on various levels, for example, work, that generation, even earlier. Actually, I am not a baby boomer because the 70s, that is probably not baby boomers anymore, but generation, who can remind me?
I do not know. I do not know if in Poland the baby boomer era was shifted a bit compared to the rest of the world, right?
Yes, a little bit, yes, but generally the generation that remembers World War II was the generation that worked to survive. That was the approach if we look at it from a work perspective. The next generation, which I happen to belong to, lives in order to work. That was the approach, and it is gradually becoming increasingly diluted. We have now reached the point where the millennial generation works to fulfill their dreams. They talk about life balance, personal fulfillment, and so on. But they do not achieve it because they still have that work ethic hardwired in their heads, which I think is positive. But Gen Z is the generation that put it into practice. So they actually start, I am only talking about work right now, not whether it works or if it is positive. They actually start applying this work-life balance. Whether it will turn out well for them, I am not convinced. But actually,
for them or for us, that is the question.
But let us get back to that original question. 140 trillion US dollars. That is the wealth that over the next 30 to 40 years will pass into the hands of Generation Z. So quite a significant effect. This is happening, of course, because generations pass on, leaving their wealth to the next generations. And there was something interesting in that lecture. They have a comparable level in how they approach thinking about the future, saving money, and the concept of ownership. Their attitudes toward planning ahead, setting aside savings, and what it truly means to own something are quite similar. And some interesting phrases came up there. For example, sociological research shows that generally Gen Z believes they will never retire. At least that's what one could conclude, because people who are currently under 27 at these years of age, practically no one, maybe as much as 90% of people, is actually saving for the future at all, really.
Okay.
For retirement, not at all. So the conclusion is, well, that they're immortal and will never actually retire.
Or that they won't live to see retirement, on the other hand.
Interestingly, I checked another statistic that people under 27, those who do save for retirement, 40% save in cryptocurrencies.
Great. So this year, after all,
of which, get this, 1/5 of that 40%, 1/5 is a pretty big number, is 100% in crypto.
That doesn't surprise me.
No?
I just hope it's in Bitcoin and not in shitcoins.
Yes. We're mostly talking about the major cryptocurrencies here. But an important thing, because this tempted me to do this research, what will happen to the wealth passing to Gen Z? What will they inherit? They will, for the most part, inherit what is generally considered the biggest piece of the pie, which is, of course, real estate.
Mm-hmm.
Real estate, and now let's look at what kind of real estate will they inherit? Well, they'll often inherit houses or apartments owned by their parents, or even more often their grandparents, which were tailored to the needs of that era. It's not about technological solutions, I mean the size, the number of rooms, and so on. And the whole concept of an apartment as a home where you live. Gen Z is a generation that doesn't attach any importance to ownership at all. They don't buy.
Car sharing, car rentals, everything is sharing.
Yes, and on top of that, the subscription model.
Yes.
So I don't buy a movie, I just subscribe to some streaming portal. I don't buy a book, just a subscription portal. I don't buy music, a subscription portal, a subscription service. A totally different approach, also an approach to living, also a place for mobility. And of course, a very significant change, which is that the family model has changed. In the United States in the 90s and 80s, the family model was 6+. A family model of 6+, right? Meaning that many people lived in a house, but nowadays they talk more about 4 or 3+. So a completely different approach. Now imagine a person who's maybe in their mid-30s already, because this will be in 10 years, for example, and they inherit a huge house with 5 bedrooms or 6 bedrooms, and they won't want to live in it. They won't want to live in it and won't want to be there because they value mobility, they value freedom, they value that work-life balance, right? That more relaxed approach. It's interesting what will happen in the real estate market.
In the suburbs especially.
Yes, a huge change awaits us in general because it might turn out that quite a lot of real estate hits the market. Well, there might be some kind of crash. I know that opinions will be divided here, but let's leave that aside. And now there's one more interesting aspect. A lot of the things that people inherit will still be burdened with mortgages. Most of Gen Z works under conditions that aren't conducive to getting loans. They aren't able to get a loan, or they won't be able to take over a loan because they won't have the credit worthiness, unless something changes in the regulations. And now it'll turn out that this exactly could very strongly trigger selling pressure in the real estate market. On the other hand, if we look at cryptocurrencies now, and this is the research I've done, it turns out that cryptocurrencies in their essence, in their approach, are precisely the ideal investment tool for this generation.
They're divisible to any amount.
I can spend whenever I want.
Yes.
So I don't have a problem.
There's no Monday from 8 to 4.
Exactly. You know, house maintenance, all that, even if you have a house for rent. Listen, if any of you are thinking about buying real estate for rent, talk to those who rent out houses, but not with the salespeople, the shills, but with someone who actually owns a rental apartment and for longer than a year. Then you'll see what a problem it is, because it is a problem. It's a problem, renovations, issues, and so on. Even if you hand it over to some company, it's still not that easy. Gen Z isn't ready for that at all. And an investment model based on cryptocurrencies fits in an almost perfect way, with the needs of Gen Z, meaning precisely that ability to buy at any moment for any amount, selling when needed. That's truly an element that cannot be overstated. And at least in the works I've come across, it was presented as one. It wasn't just about cryptocurrencies there. Those weren't sociological studies related only to cryptocurrencies, but rather it was about saving from the perspective of Gen Z specifically. That right now they don't have money yet, they're not thinking about saving yet. That will change within the next, let's say in about 10 years, when Gen Z begins to truly face the reality that we are not in fact immortal after all, and the process of saving will really begin. At that time, they will be shown which investment models are considered the most attractive, and at the very forefront of these models are precisely cryptocurrencies. And it seems that this will be one of those additional mechanisms that can pump the crypto market, maybe not in this cycle, if we believe in cyclicality, of course, maybe not even the next one, but the one after, who knows. So that $1 million on Bitcoin is not a pipe dream. I think it might actually turn out to be achievable even sooner than we might have thought, you know. Well, of course, the question is, when will Gen Z start saving? Because that is the key question. That moment will definitely come. That's for sure. It might seem to me as a boomer, it might seem a bit too late when I look at my kids, though I have no complaints there. But when I look at young people, yeah, it seems to me they should be thinking already. That moment will come maybe in 5, maybe in 10 years. And indeed, these cryptocurrencies as an investment tool will be an excellent solution for them, especially since they'll likely start feeling the effects of inflation too, because the inflation we have right now, this long-term one, is worldwide. I mean, worldwide, not just in Poland. Globally, it's one of the highest we've ever recorded. This isn't something that's happened before. It's happened. There was inflation in Poland. In some countries, there was inflation resulting from, say, a bad economic model, but a global one like this, well, that's currently a huge shock. And with real estate problems, because I think a correction in the housing market is coming, well, they'll be looking at that, gaining investment experience by looking at these assets, at these things. And it'll turn out that neither money in the bank nor money in the form of real estate works. Additionally, real estate has this problem of being tied down, of obligation, and something that Gen Z doesn't like, doesn't care for. In general, not in particular, because I'm consciously generalizing here, and then it'll turn out that all those solutions that are passive investments like that will be gaining importance, which also bodes well for precious metals, for example, because that's also a similar investment model. But
But yeah, when it comes to the statistics among young people regarding investing in precious metals, they are
terrible. These cryptocurrencies look quite good. As I said, 40% of people from Generation Z who
save
in cryptocurrencies, of which 25% are only in cryptocurrencies. So overall, that suggests a pretty good future. We'll see if they manage to realize their profits.
All right, so if we're already investing in cryptocurrencies, especially young people, but not just the young, then we move on to the question of where, and we're thinking about saving, right? We're not thinking about trading. We're not thinking about, I want to buy, sell, I want to invest long term. So let's be honest, even as someone who works at an exchange, and you, Lucas, surely too, I recommend to people, if you're looking at this long term, withdraw from the exchange to your wallet every now and then. Keep some funds on the exchange that you need for purchases or for some smaller pleasures, because you can also pay by card. We have various options, but as a rule, especially when it comes to Bitcoin,
we keep it in our own wallet. Here, of course, a clarification: withdrawing to a hardware wallet is de facto not a withdrawal to that physical wallet, but simply to our address, which we have access to thanks to the hardware wallet. This is one of the safest ways to store cryptocurrencies. But now, and I think this wasn't entirely intentional, in Europe, this MiCA appeared, regulations appeared, and suddenly it turns out that it's very possible that some alternative will emerge because, after all, this hardware wallet is a barrier for many people. It's something difficult, complicated. From my perspective, no, but when I look at my friends, well, geez, it's not that trivial after all. They have various problems, and what's simple for me is harder for them. I say, okay, so a solution must be created.
And, there's the issue of storage. That's definitely a difficult issue for me. The issue of inheritance. These are stages that are more difficult because I personally know people to whom something happened once and the family doesn't know. They know he had Bitcoins and don't know where.
Oh boy, that's it. That's the worst situation. And exactly, and here a certain solution, a pretty good one, but I emphasize this is a solution rather aimed at people who aren't cryptocurrency freaks, but are just regular normies.
And don't want to leave the system. Let's also point that out.
That too, although it's already on the borderline, I'd say, right?
All right.
Tell me. Because if certain regulations are created, then a certain mechanism of greater trust is created. And whatever one might say about these regulations, we can certainly say that the introduction of the MiCA regulation has already caused those shady exchanges, those exchanges that weren't entirely, let's say, honest exchanges. They're already feeling it quite significantly. Several exchanges, I'll admit honestly, I didn't even know such exchanges existed, but these exchanges have already started to stop payouts. They blamed it on MiCA, of course, and that's their excuse, while in reality it turns out that there probably was...
They didn't have enough funds?
Yes, exactly. And now these kinds of exchanges have crashed. Regulated exchanges will ultimately dominate the market and are a pretty good solution for whether these exchanges can provide certain additional cryptocurrency storage services. Not on a typical classic brokerage account, I think, but rather on a dedicated platform that serves to store the cryptocurrencies of someone so that they feel they aren't left to their own devices. I like being responsible for myself. That suits me just fine. But in the case of some people, they want to have somewhere they can call if needed, where they can report something and, for example, get access back to their funds when they forget their password.
Coinbase, after all, provides these services in America for most investment funds.
Exactly. So Coinbase runs a wallet management service so that an investment fund doesn't have to worry about those private keys, security, and so on, because Coinbase provides all of that. And I think that European exchanges will also be introducing these types of services. And that is one of the few, but I think it's worth noting, benefits, because by being a regulated entity, they are subject to, with some regulation and some oversight in place, we can have greater confidence that, for example, the funds we transfer to the wallet will not be used for any other purposes. This means we can trust that our money is being handled as intended. This is one of the benefits, because I'll remind you that MiCA specifically states that these client funds cannot be used by the exchange or by the regulated entity in such a way that they're used for something else, like the exchange somehow making extra money off them. No, these client funds must be segregated, and they are kept at separate addresses, not mixed at all with those corporate addresses, from which, if the company has cryptocurrencies, with those exchange addresses. And as a result, they are, let's say, somewhat safer. I'm intentionally saying safer, not 100% safe. So yes, they are safer than they have been until now.
So for example, we can think of, for instance, a common practice in the crypto market on exchanges. It was that exchanges would keep client funds on other platforms, on other exchanges, to take advantage of their liquidity.
For example, that is one of the common practices, but I would mention a more important element, because I know of cases where it is actually, as you say, someone had Bitcoins, some unfortunate accident happens, and they lose access. I mean, let's say it happens, the person dies,
and
the descendants, the family, they say, we know he had an account on this or that exchange, and we know he had millions there, but we can't get access because we don't know what kind of account it was. We don't know the password. We don't know the email address. I know myself, I have friends who create a separate email address for every
email.
It's not an email address used for any correspondence, so no one knows that such an email exists, so there's no way to even recover access to that address. And on top of that, they don't verify ownership of that account in any way. So the exchange doesn't know who owns those funds. Introducing the KYC procedure. I'm intentionally talking about the positive sides right now, not the negative ones. The positive side is that the exchange knows who the owner of those funds is, has a full verification of that person. And in the case of, for example, an inheritance matter, has a clear procedure for what must happen. So if the family comes forward, presents the right documents in the right way, and authenticates everything. This is not a procedure that will take an hour. I'll point that out
right away. That's obvious. It's just like in a bank.
Yes. Taking over an account after a deceased person is not trivial, but
it can be done.
Yes, and in a reasonable time. Let's emphasize that. It's not 5 years. These are short periods, but
you have to collect all the documents. We have to check them, the credibility and so on.
Exactly. And at that point, we can gain access to those funds. Inheritance matters of some sudden accidents can actually work better.
Here. Or even losing access, as you said.
Like those people we talked about during previous episodes, some narcomiers, people who lost access because they forgot their passwords. That one student in Germany who, after coming back from a party, changed the encryption password of his drive and doesn't remember it, and he has 6,000 bitcoins there. And that's a bit of a problem. 10 attempts were allowed for the password. He's already used 8. Entering the wrong password for the 10th time will cause the drive to be
completely and utterly wiped out.
Tricky stuff. And here, of course, these MiCA platforms are appearing, and it seems these platforms regulated under MiCA seem to be a pretty good solution, especially for people who, well, aren't exactly tech freaks who know what private keys are, and or on the other hand are just afraid that, I don't know, they'll lose them or forget them, or that something will happen. I think that here, having such a wallet for storing cryptocurrencies on some centralized platform is not a bad choice at all.
All right, I think that we can move on to the most substantial part.
Yes, this is the moment.
The creme de la creme, meaning what everyone is waiting for. Facts, not myths, authentic facts. Lukasz, do you want to start?
Yes, I can start. I have such a practical but thought-provoking philosophical fact here. Listen, it turns out that is actually quite a large number of islands, and not just some exotic ones, but for example, islands in places like Scotland or even in Canada can be bought for really, truly ridiculous amounts of money. In fact, the prices for these islands are so low that it might seem almost unbelievable, but it is absolutely true. Much, much less than the price of, for example, I don't know, 1,000 square meters normally on land. And the island has a much larger area.
So where is the catch?
Well, the catch is of course, there must be a catch. And that is exactly what illustrates the situation. Well, it turns out that these islands are totally devoid of any infrastructure, meaning there is no electricity, no water, no energy sources.
There is no way to get there. You must have your own. There is not even a port.
Yes, you have to do everything. Do everything yourself. And the nearest neighbor is 200 kilometers away, right? And here, I would summarize this interesting fact in this way. Not always what looks good on paper because it is cheap, because it is large, and because we can look at it that way, right? Oh, okay, 10,000 euros, 20,000 square meters, completely owned, without any catches. Everything is fine. I can build what I want. I can do what I want. Hey, well, great, right? But yet no, and it may turn out that it is better to buy. It is better to buy a studio apartment in the city than such an island, of course. There are exceptions. There are people who would happily move to such a place. Well, but let's talk here generally about.
There is a very large investment outlay needed.
Terrible here.
Unimaginable, even hard for us to.
I watched a few such videos. Well, it is not simple. It's not easy to tame an island like that and bring it to a state where we could live there peacefully. And anyway, let's remember that it always starts with. At first, there's a problem with water, electricity, heating, delivery of goods, delivery of food. And then there's always a problem with, for example, the doctor and access to care.
Primary. Sure. I have an interesting story. I won't use names or surnames or the place of residence to maintain some confidentiality. This story is confirmed. So there was this gentleman, you could say, a shady character. He moved in such a suspicious, dark environment and was considered an important figure in that circle. And let's say it was the end of his reign. And one day someone stole his car from right in front of his big villa. Well, and the gentleman got very upset. Who had the audacity to steal his car? So he made a few phone calls because he knew a lot of people, to find out who it was. No one admitted to it, but the next day the car was parked in front of the house, washed with an apology letter and an invitation to. I don't remember if it was the opera or theater, the kind that this gentleman liked. An invitation for 2 people, for him and his wife. He kind of understood it was a gesture, that maybe someone did something stupid, didn't know what they were doing. He went to that theater. When he returned home, it turned out the whole house was empty.
Oh, that is honestly just so incredibly brazen, you know?
And that was exactly the end of this gentleman's story in that circle. It was a sign that this gentleman no longer meant anything. And speaking of a change of generations, that was a generational change in a certain environment.
On the other hand, let's remember, and let's not forget then, let's not be fooled by
a Trojan horse.
Yes, buy something for free, because there's no such thing as a free drink. Sacred rule. If someone gives you something for free, gives you more,
you are the product.
Yes, it means that either you are the product or that person, in the simplest way possible, is simply trying to cheat you. For me, the golden rule: if someone calls me and offers me some investment, I immediately hang up the phone.
Yes, of course.
And add the number to the blocked list.
If, and this is a warning for the future, if anyone ever calls you, I guarantee you that good investment opportunities don't call you.
Yes, good investment opportunities you have to find on your own. And to make sure you don't miss them, you should subscribe to this channel, listen to our content, and I especially invite you, of course, to the next quarter with Kanga, which will be on Tuesday at 9:30. The only crypto breakfast television like this on the entire internet.
Join us, click subscribe, give us a thumbs up. Thanks, Łukasz.
Thanks, Marcin. Thank you.